Hello, traders. How are we doing today? Happy May 1st to you all. I hope that you're doing great. My name is Jason Krutzky. It is a pleasure to be with you again for yet another FOMC announcement. We're going to get this data here in about 15 minutes, and I think we all kind of know what to expect, right? They're probably not going to raise rates, and they're probably not going to decrease them either. We're probably going to get a sit and wait. And really what it's going to all boil down to is what Powell has to say about things. And so we're going to watch that as well. We'll watch the initial reaction of the markets, and then we'll watch Jerome Powell's presser. How are you guys doing today? Are you doing well? If you're here, please say hello. I don't see anybody here, but if you're here, please say hello. Okay. Now I see some data. I see there are a few of you here. Very glad to have you. I thought in the 15 minutes before the announcement, we could do a couple of different things. What's up, Anurag? Good to see you. Thank you for being here. The first thing that I'm thinking we can do is we can go ahead and prepare our multi-symbol view with all of the names that you guys might be interested in checking out. What's up, Muhammad? Great to see you as well. Thank you for being here. I've got a handful of things already up here. The Qs, the SPY, the IWM. I've got Bitcoin. I've got gold. I've got 10-year Treasury ETF. I've got crude oil futures. I've got VIX, Tesla. What do you guys want to monitor? Y'all let me know, leave your requests in the chat, and we will add a handful of different tickers to the multi-symbol view so that we can all kind of keep an eye on the things that we really want to keep an eye on when the announcement comes across the tape in about 13 minutes. Hit me with what you got. In the meantime, while I'm waiting for those, yeah, Anurag, we got it right here up in the upper right-hand corner. So I'm kind of thinking in the meantime, in the next 10 minutes, let's kind of just take a look and see kind of where we're at right now. Just on the major indexes, I figure that's probably a decent idea to do. And, you know, if you guys have any thoughts, please feel free. What's up, Chewy? Yeah, you know, TNX, I believe that there is currently, there's currently an issue with TNX index data. So that's why I've got IEF up there as the alternative. If you prefer a different alternative, Chewy, let me know and I'll add it instead. But here on the daily, on the Qs, the first thing I want to take a look at, you know, I've been talking a lot about seasonality. I think seasonality is really interesting, especially right now. We're in an election year. We've got seasonality filtered for all non-election years. Essentially, all we're seeing here is data on election years, and so far so good, right? We got exactly what we would have expected in April based off of historical data since 2000. So this is what? This is essentially six years of election year data, and generally speaking, QQQ quite weak in April. Now our weakest month of the year, it's coming right around the election, right before the election, 17% win rate in October. But this is interesting. I mean, I'm curious if you guys are kind of feeling like everyone is getting way more on the short side. What's y'all's sense of the markets right now? Is positioning for more downside, or are people positioned for maybe the lows are in for now and it's going to continue higher? Seasonality on the Qs kind of suggests that there is actually the chance for that maybe the lows are in. I'm not saying that they are, but it's kind of interesting that seasonality gives this view. You've got relative strength throughout the summer with kind of a peak performance showing up in August. Kind of not how it feels like it should be right now, but maybe that is exactly right. Oftentimes that's how it is, right? When the markets feel extremely bearish, that's when you should be buying. When they feel extremely bullish, that's when you should be selling. You've got a key breakdown here. You got your 20 SMA on the daily, that this thing has just been grinding higher on for, since the October lows. They finally lost it. They retested it a couple days ago. But they're catching a bid right at the anchored VWAP from those October lows too. So this is a pretty key spot. I've got the volume by price locked to those October lows. So below that, things start to get a little dicey for sure. Your average buyer from those lows no longer in the money. But right now, those buyers are doing okay. Switch it over to the SPY here. And relatively similar look. That 20 SMA been a key moving average for months. Been riding it higher since those October lows. We lost it. We've tested it. Now we're breaking down below it. Trying to hold higher lows here. You've got the anchored VWAP slightly lower on the SPY relative to the QQQ here at 483 or so. Just about 10 more minutes until the announcement. Sell in May and go away doesn't apply to election years. Well, here's SPY election year seasonality. April, not nearly as bad as we see on the Qs. Into May, into June, win rate increases, but mean change decreases. So a little counterbalance there. July tends to be not so great, but then just like with the QQQ, August tends to be quite good on the SPY in election years. So really kind of looking for that August move. If we switch over to the IWM, again, similar to the Qs, right? That 20 SMA, it's been kind of tracking it ever since the October lows. They failed below it. They've retested it. They got rejected, but they're holding the VWAP again from those October lows. If we pop over to election year seasonality, well, strongest month of the year for the small caps coming in December, which would kind of be interesting. You know, small caps have obviously been struggling because of interest rates. Maybe there will be some sort of change of pace with interest rates before the end of the year. Maybe there will be some, even though everybody is kind of anticipating that there will be no interest rate changes this year. Maybe we'll get a surprise towards the end of the year. Maybe towards the election, something will happen. President will pull some strings. I don't know. But it is interesting to see across the board on all the indexes or all the major index ETFs, you tend to have a really strong August in election years, followed by a really, really weak October. I'll go back to SPY here. Again, really weak Octobers for SPY. So, you know, maybe there's a trade there, a long trade through the summer. I don't know. But maybe there's a long trade there through the summer. Sell into that August strength. Close it out, maybe consider some short positions at the end of August or sometime in August if you do get this powerful move that month, and then try and take your longs again kind of towards the end of October, sometime during some October weakness. It'll be interesting to see if this actually plays out. We've been seeing it in other sectors and other areas. If we look at energy, or rather bring up XLE. XLE highest mean change is in April of election years. We were talking about this. If we go to individual names here, like XOM or something like that, it's even a clearer view. Election year seasonality for oil tends to be quite strong. High win rates, high mean change percentages. But now that month is behind us and things are starting to weaken again. So I don't know. What are you guys thinking? Do you have a chart for Starbucks? Sure. Do you want to put Starbucks up on the multi-symbol view? Is this one you want to keep an eye on for the announcement? We certainly can. Kristalla, thank you for being here, by the way. Why not? What's up, man? How are you? Hope you're well. We have just a few minutes until the official FOMC announcement. Probably will get some sort of reaction here. Are there any names in particular that you guys want to keep an eye on? I have room for about 6 more names here. Happy to add any tickers that you guys want to monitor. And generally, what are you guys' thoughts? You know, I'm just one guy. I'm curious to know how you guys are feeling about kind of where the markets are at right now. Do you feel like there's more downside ahead? Do you feel like things have bottomed and we're going to start catching a bid a little bit? Do you feel like are we kind of at max fear about interest rate hikes at this point? Are we not there yet? What are you guys thinking? Good afternoon, Jay Trades. Let's take a quick look at GLD. This is actually another really good one to take a look at seasonality on in election years. Looks like your strongest month of the year is June, 100% win rate since 2004 for GLD during election years. Your second highest mean change as well. As far as kind of what's going on the chart, whenever I'm kind of looking at stuff, I'm always going to zoom out first, right? We want to see the long-term view. Obviously, very clear break after a multi-year, a decade and a half of highs, right? They're just finally clearing those highs. So, I mean, this is a really, really important breakout, clearly. It's taken them a long time to do this. So I would imagine that this breakout probably has some legs. If we pull back here, a couple of things that I would do, I would kind of look at the near-term lows. So this is pulling from the 2022, October 2022 lows. This is just a volume by price. So where is your volume? Where is your average buyer? Where's your VWAP? Where's your point of control? Pretty clear spot here, 185. You know, it was the kind of the level that really brought this whole push higher. They gained it, they pulled back into it, finally held it, and then pushed higher. So then I'm going to move volume by price to that spot where the breakout really started, essentially about here. And so from here, big key spot, you've got your VWAP from that spot. This is where your volume weighted average price from those February lows. If they do end up selling this off a little bit more, wouldn't be a surprise. Be looking for somewhere around 206. Be looking for what they do around 206. Maybe a little bit further, a little bit deeper, kind of into this area here. Let's go back to the weekly. So this would be kind of interesting. I'm always going to measure a fib sequence, and I'm just using the auto fibs. So TrendSpider auto fibs automatically measuring this swing for me. I know that the 50% retrace at 204, 0.618 retrace at 199 or so. So I'd be looking for somewhere in there. Look for the correlation between kind of this fib area, 50% retrace, and then that anchored VWAP from those lows. I'm going to pop back to multi-symbol view here. We got about 1 minute until the announcement. Any other tickers anybody want to keep an eye on? I just saw Meta. I'll add Meta right here. Etsy. What's up, Naresh? Hope you're well. Chewy, yeah, you think so? This is, I mean, Chewy, I have to be honest. It's kind of where my head's at with it, too. Chewy, yeah, you think so? This is, I mean, Chewy, I have to be honest. It's kind of where my head's at with it, too. I kind of have this weird gut feeling that they might be trapping some shorts right now. And they might give us a little surprise to the upside. I don't think that we're going to just automatically make a new all-time high. But I have a weird feeling that they might trap some folks. I don't know. We'll see. We'll see. It really, you know, this initial move looks like it's an upside move so far. This initial move means very little relative to what actually happens tomorrow, you know, and what happens when Powell starts speaking. I'm going to add Baba here. I know my buds over at All Star Charts have been talking China names. Let me also add weed. Why not? All right, so initial move higher. Fed keeps rates unchanged, as expected. Hola, Raul. Thank you for being here, sir. Muchas gracias. Everything kind of acting pretty much the same way. Oil unchanged. VIX selling off slightly. Bitcoin gaining slightly. I think it all really boils down to old J Powell today. I'm just having a hard time kind of trying to figure out what he could say to really change much of the sentiment. Chewy, long-term, see a high-level consolidation between weekly SMA 10 and weekly SMA 21. On what? On SPY? Let's see this. I want to see what you're seeing. Ah, yeah. Why not? Do we want to look at SoFi? We've got half an hour until Jerome comes up. I'm going to have him hanging out right here. So once he is live, I'm going to turn the music off. I'm going to stop talking, and we're going to listen in to what he has to say. But in the meantime, while we wait, let's look at some stuff. Let's look at SoFi really quick. Let's take a look at seasonality on SoFi. I'm going to remove all of that, because this thing essentially has very little data. Give me one sec. May, though, strongest month of the year for SoFi historically over the past 3 years. Highest win rate, 100% win rate. All Mays have been green. Your mean change in May, 13.31%. Let's take a look at the daily here. Remove some indicators. First thought here would be to check out that volume by price from these lows. And this is a little concerning, right? From those May 2023 lows. You're trading below the VWAP and point of control from those lows. You got lots of overhead supply. You can see it in the volume profile here on the right-hand side. But that is interesting. Meta headed higher. You have it mapped at 454 this week. Let's zoom out a little bit here in SoFi and see. Since this thing is so young, I almost always will do this whenever I'm on looking at a ticker that is only has a couple of years worth of data, an anchored VWAP from the IPO date, just to see, are your average buyers in the money, not in the money? And right now they are trapped below overhead supply. So for those of you who are familiar with market structure, style of trading, fair value gaps and ICT and those sorts of things, there's something that I see here. You've got essentially this. You have a big break of structure right here. Right? You're in a downtrend. You're in a very long-term downtrend, and they were finally able to make some new highs relative to this guy and this guy and so on, right? We made some new highs. So came back, they tested where we kind of broke structure, but there is another level here, kind of down in there. So if this thing does continue to sell off, your best spot to kind of be looking for new long ops, because they did not make a new high here. So that's a little concerning. You know, in uptrends, you make new highs, you make higher highs, you make higher lows. They're trying to hold the low right here, right? This is the previous low. So they're trying to hold that low right now. The fact that they did not make a new high relative to this guy, though, is a little concerning. You would have wanted to see them make new highs first, in theory. Doesn't mean that they can't hold it here and continue higher, but this failed high here kind of suggests the potential for another low. So essentially, if they are to make a new low below this one, the November lows, if they make a new low, then you're at what's called exhaustion risk. The move could get exhausted anywhere below a new low here. So personally, if it were me and I were trying to trade it, I'd be looking for them to take out this low and start looking for low time frame change of trend, bottoming action, all the way down to here, 510. Let's see here. Let me add UUP and just see where we're at. I mean, if you're bullish, I'll say if you're bullish equities, this is what you want to see out of the dollar. You want to see the dollar selling. Inverse relationship, right? Dollar goes up, stocks tend to go down. Dollar goes down, stocks tend to go up. So this is what you would want to be seeing for sure if you're bullish equities. ARMN. This is a gold miner. Ooh, what? I tend to stay away from tickers that look like this. This looks like it's a junior gold miner, though. Right at the point of control from the 2015 lows. Seasonality on its side in July. May tends to be pretty weak, though. Over the past 13 years. Let's take a look at the Starbucks real quick. Lottery ticket. All right. All right, so let's do this real quick. Let's take out, see if there's anything there. An election year seasonality for Starbucks. It's been a company for a long time. So strongest month of the year in mean change terms, March. Weakest month in mean change terms, April. Kind of best overall month, not until November. It follows the same kind of playbook as the indexes, the index ETFs, with a very weak October. Let me go to the monthly here. I just want to see kind of where we're at. I mean, this is pretty ugly looking, isn't it? Certainly easy to see kind of the head and shoulders pattern that appears to be forming on the higher time frame. Again, kind of the same idea here as SoFi. They did make a new high. They failed to make a new high. Uptrends, you would expect a new high being made, and they failed to. So you kind of have to anticipate that they're going to at least take out these lows here, around 67 bucks. If you anchor your volume by price from kind of like the 2015, the beginning of this 2015 consolidation. So it's just showing us all the buyers, all the volume since that time. I'm anchoring it there because I'm almost certain, yeah, this is problematic, right? From your 2018 lows, all that price action we've just now broken down below that point of control and the VWAP. So now you have tons of overhead resistance there. So now we're looking for places where price could find some support. So we anchor from kind of the beginning of this 2015 consolidation, 2015 through 2018, breaking down below the VWAP. You've got the point of control there at 57, 58 bucks. Could it go there? Sure. I mean, technically, again, just like that other, just like SoFi, anything below 68 is potential exhaustion risk. The goal, after they've failed to make a new high here, the goal then would be to make a new low, which would be take this low out. Doesn't mean they can't continue lower, but kind of how I would be thinking about it personally. MSTR. Yeah, this one's tricky. The Bitcoin proxy. Pop back over here, see how things are looking. Bitcoin continuing to grind a little higher. Index ETFs gave up most of the initial move. That's okay. Again, we're not going to really know until Powell. Let's take a look at master election year seasonality. Very weak through the summer. Let's remove it. Historically, best month October by a long shot. That's kind of interesting, right? When the the index ETFs are usually doing bad. Naresh, yeah, I mean, 1400. You think so? Let's look at the daily here. Started this move. So kind of from the start, maybe like right here, from the start of this real extension higher back in February, we are now trading below VWAP and point of control from those levels, or from that spot. So this could end up acting as some overhead resistance back into your area, 14, 13, 1400. Looks like there's a little fair value gap here that is unfilled. Just adding a fair value gap indicator real quick. Yeah, there it is. Sure thing, Christella. But Naresh, yeah, I mean, it definitely could. I think if indexes are to catch a bid and they go and test something higher, maybe they go and they fake out and go make a new high, a new short-term high, something just above the last week's highs. You could definitely see that move back in MSTR, back to 1314 before a continuation rollover. Certainly possible. Chewy, you're an AI. Let's take a look at AI. Another kind of, is this also a lottery ticket? Looks kind of like your gold miner. So from those January 2023 lows, definitely stuck below overhead supply. Expanding the range that they've been in for what? Since September 2023 recently. They made new highs and then they've made new lows. Excuse me. Pretty tricky, but this seems important. Same kind of idea. Same kind of market structure. You had this break of structure here where they were able to make a new high. So to me, that $20, $20.50, pretty good risk off spot for you. Avgo. This one seems worth checking out. Election year seasonality for Avgo, kind of the same as the Qs. Very, very weak in April. That strength kind of comes back over the next couple of months. Not much to say about this one, but, you know, in a clear downtrend, right? Since the March highs, making lower highs, put in a slightly lower low here. I mean, expectation would probably be a continuation lower unless they can reverse this like now and make a new high. Wing has been a monster, hasn't it? I wouldn't say it's sleeping. It's definitely not sleeping. Maybe there aren't a lot of people talking about it, but it's awake. And it has been. It's certainly bucking the trend. That is for sure. This thing has been very, very impressive. 9 years worth of data. Let's check out seasonality. So May's historically not so great. Just kind of mediocre. But it's really kind of been bucking. Gosh, it's been bucking its trend for a minute. So hard to know. With this, it might make sense to use fib extensions to kind of gauge. Now, which is the right fib extension? It's hard to say. Some people might use this one. Some people might use this one. But it is getting up there, isn't it? With this, it might be a decent idea to kind of keep an eye on momentum and see if you get any momentum divergences. It's interesting to kind of see you've got clear momentum divergences here, but they haven't meant much. Previously, August 2019, very strong RSI. You have a divergence here in August of 2020. So over the year, they made new highs, but then it was divergent. ultimately you get a pretty gnarly sell-off. And then it's really surprising actually to see that this thing has gained so much, almost 100% from its previous high. And RSI hasn't managed to make a new high yet. It's kind of wild. So definitely some momentum issue going on here, but doesn't mean it can't continue to grind. It's certainly bucking the trend of the overall markets. So you got to be keeping an eye on it. I want to look at K-Web real quick. Let's actually go back real quick and just see kind of where we're at. We've got about 9 minutes until the Powell presser. Actually, K-Web. We got to look at the daily on K-Web. Good to see them holding a higher low. If you're bullish from those 2020 lows, October 2020 lows. And it looks like they're trying to flip support resistance here. The VWAP point of control between, $27, $27.5 has been a key level since these lows. Key level where price has kind of been fluctuating around, acting as support throughout summer 2023 into the fall 2023. They failed below it. They retested it in March, failed a couple times, and now they're gaining it again. So we're looking for a big support resistance flip here. They have still yet to make a new high, right? If this section of the chart is essentially the swing, you're still trading within it. So next step would be a new high. That's what you want to see if you're bullish. Let's look at seasonality. This thing hasn't been around very long, but here is election year seasonality per how long it's been around. Not a ton to deduce from this data. It's just not very much data. But certainly interesting in this area. It's been a key spot. Probably keep a close eye on that. Meta in 2 years. I have no idea, man. I don't like to make those sorts of guesses. Yeah, no idea. Because who knows? So many things can change over the course of 2 years. Completely outside of the company's control. We just don't know. And I don't know enough about what they have forward looking to give you any sort of guess. Yikes. This looks not great. I haven't looked at the cruise liners in a while. Historically quite weak in May and June. August is your best bet for a green month. August, December. Election year seasonality, pretty lousy for May. Again, not much data here, just a couple of years. So take it with a grain of salt. But let's see. From these lows, the one thing you got going for it right now, as a guy who pays attention to price action and trend, you made a higher low. You held the lows from 2020. So that's really all you got going for it. This thing looks pretty ugly, but if you were to put a feather in its cap, you would say, well, it held the low. from 2020, and it's slowly trying to grind higher. It's trading right at the point of control where your most volume is from the low, from the 2020 low, March low. But looks pretty trapped. Seems like perhaps might be some better names to trade than this one. We're about 5 minutes away. ETF, index ETFs, trying to make a new high here. VIXI continuing to sell off. Oil untouched. The dollar kind of flat. Gold kind of leading. IWM too. That's an interesting thing. So what do you guys think? Jerome Powell, what do we get out of Jerome Powell? Thoughts on how to use unusual options data with trends, PA, seasonality. So Ivan, it's a great question. The way that I kind of use it, as opposed to looking at specific, at the specific flow of an individual name, the way that I'll do it is in what's happening now. Let me show you. I like to filter simply by kind of bigger orders and then by specific tags. So with premium, I want to see premium generally above like $1 million. And then I want to see sweeps at the ask. And what this is all about, you know, if it's a sweep, then the buyer or seller is just like trying to get it wherever they can get it. If they're paying at the ask, they're willing to pay up for it. You can even say above ask too, right? If they're buying above the ask, they just want it. Why do they just want it? You know, it's just kind of a more conviction style of order. And so once I have that information, then I'll look and see kind of what's actually meeting that criteria. And, you know, sometimes my values will be too high. In that case, $1 million was a little bit too high. And really, it's clearly too high today. Like, there hasn't been a ton of big money order flow today. You only have one order here on NVIDIA above $500,000 in premium. That's kind of interesting. So like that tells me something. You know, people are kind of sitting on their hands, waiting, not sure, not taking big bets. Sometimes you'll have a ton of them and it'll all be sector specific. So it can give you an idea of like where you need to be looking. Maybe not exactly the specific name that you need to be looking at, but just like, where should I be looking? Are these call biased? Are they put biased? Are all of the biggest orders today, are they in energy names or are they in tech names? You know, what types of orders and where are they? Is kind of more how I think about it than utilizing this view where you see just the entire unusual options, all of the available unusual options orders per one individual ticker. It's cool to see this too if you have a specific name that you're watching. But if you're kind of looking for opportunities, then I'm going to use this. I'm going to use the unusual options data in what's happening now, and then I'm going to filter it for what I'm after. And again, you may want to even you can add calls in there. And actually, I guess that, hold up, let's do this. So this is just going to show us the calls that are meeting all of that other criteria, right? That's kind of how I think about it. That's how I would use it. And then from here, you can kind of pull ideas. You can just pull up those charts very quickly. All right, Powell's up. Let me grab him. If y'all have any trouble hearing, just let me know.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I remain squarely focused. The economy has made considerable progress toward our dual mandate objective. And stable prices for the Inflation has eased substantially over the past year, while the labor market has remained strong. Mandate objective, and that's very good news. Inflation has eased substantially, but inflation is still too high. While the labor further progress in bringing it down is not assured, and the path forward is uncertain. Inflation is still too high. We are fully committed to returning inflation to our 2% goal. In the path forward, restoring price stability is essential to achieve a sustainable strong labor market that benefits all goal. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Today, the FOMC decided to leave our policy interest rate unchanged. Our restrictive stance of monetary policy has been putting downward pressure on economic activities. Our restrictive stance of monetary policy has been putting downward pressure, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objectives, and we remain highly attentive to inflation. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. Improving supply conditions have supported resilient demand. The payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and the continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Refresh, yes.
The inflation data received so far this year have been higher than expected, although some measures of short-term inflation expectations have increased in recent months. Longer-term inflation expectations, although some measures of short-term inflation expectations have increased in recent months. Longer-term inflation expectations, although some measures of short-term My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that, that policy is restrictive.
Sufficiently restrictive, I guess. Is it?
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored?
or anchored?
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, you know, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. You know, our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? You know, I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data to answer that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, you know, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, you know, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. I mean, is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent Has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking,
Steve?
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again.
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do that. I mean, you can go back and read the transcripts for every. This is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, you know, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours, or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we will be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think, we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but, you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly more diverse than it used to be in many dimensions, more diverse from the obvious gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
All right, guys. Well, how do we feel about that? I thought it was pretty interesting. Markets, of course, seemed to like what he had to say, which, you know, perhaps no news is good news. Maybe that's kind of the feeling here. Did you guys take anything from it that you thought was really interesting? I was taking notes over here. Seems like he's not as confident, or he's not as confident in the rate at which they'll get to that 2%, but he still seems very committed to 2% inflation. Very confident in that we'll get there, just doesn't know when we'll get there. He seemed strongly opposed to the idea that we are in a stagflation period. Those are kind of some of the main little bits that I noticed. He also, interestingly, the election piece, whether or not the election would play into their decision, if any of these guys would have that ability to, I don't know, get them to sway their positioning before the election. Sounds like that's not on the table either. So I don't know. What are you guys thinking? How are you feeling? If anybody has any questions about anything, hit me with them. I'm going to hang out here for another few minutes. Unless there are no more questions, then I'll probably just jump and we'll get back to doing our thing. So let me know if you got anything. What is up on the horizon? Well, we got, it's May, it's a new month. We got Cinco de Mayo coming up. And I'll give you guys a little clue that there's something happening for Cinco de Mayo. We've got fundamental data coming. We've got market maps coming. If you haven't seen it yet, Market Breadth symbols is now available on the platform. These guys are super helpful, in my opinion. I'm going to give you guys a link really quick. If you have not yet played around with the market breadth symbols, I really think you might find some good use in them. Here is a link for you. This gives you all of the market breadth symbols that are available, some thoughts on how to utilize them, and so on. For anybody who attended the webinar that we hosted a couple weeks back, probably going to be another one of those coming up here in a couple of weeks' time. So some big things coming. If you guys need anything, you know where to find me. At Krutzky Trades. I'm going to give you guys a link here. That's my Twitter handle. My DMs are open. If you ever have a question about TrendSpider, want to know more, need some help understanding how to do something, never hesitate to reach out to me. Also, we have a live team, support team on staff Monday through Sunday. Let me make myself a little smaller here so you guys can see it. Contact us button down in the bottom right-hand corner. These guys are live every single day, Monday through Sunday. There's almost always someone around who can answer a question for you. So if you having trouble understanding how to do something, need some help, have a question, whatever it might be, feel free to hit these guys up. They are around. All right, y'all. Well, again, it's been a pleasure. Thank you for joining me. Thank you for sticking through the little audio issue that we had there when Powell started speaking. Glad that we didn't miss any of the presser part. That was really the important part. We got to see all that. So I hope you guys have a great rest of your trading day, a great rest of your week. Holler if you need me, and we'll see you all again very soon. All right, bye.